Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Well, as I record this, we've just passed the first 100 days of the Trump 2.0 administration. And in this episode, I want to get into, obviously, things that have happened over those 100 days and sort of where we're headed from here. But, to start out, let's take a look back at history. This idea of the first 100 days has been a symbolic benchmark that has been used over various administrations to kind of assess the administration's effectiveness, priorities, and focus, really. And it began actually with Franklin D. Roosevelt in 1933, where he, in the wake, basically facing down the Depression, the Great Depression, acted with real urgency. So passing 15 major laws, issuing 99 executive orders, and the whole effort, interestingly, ironically in a way, was designed, much of it, to greatly expand the role of government, of the federal government. And so, over the years, not many people sort of had that level of activity in their first 100 days. But as we know, when we look at the Trump administration, they've tried to do a lot, and interestingly, almost like in the other direction, meaning trying to undo and sort of shrink the size of federal government. So anyway, let's get into some of the details, talk a little bit about some data we're seeing, and how to interpret it given what's going on, and then maybe a little bit about the future. So as it relates to the actions, as an example, so I mentioned FDR's 99 executive orders. Over the first 100 days, 142 executive orders from the Trump 2.0 administration. We know that there's a significant, essentially, elimination of the Department of Education, the U.S. Agency for International Development, a downsizing of the Consumer Financial Protection Bureau, and then, of course, the creation of the Department of Government Efficiency, of DOGE, looking to kind of improve spending, looking for inefficiencies. And while people will debate the specific numbers in certain circumstances, in round numbers, it's about $160 billion that DOGE is pointing to so far in savings. Now, all of those things by themselves, those are all pretty dramatic moves, obviously. But the other one that really came into focus in the media and the markets was Liberation Day. So the idea of essentially imposing dramatic and widespread tariffs on dozens of countries, and that was shocking. And of course, the market traded down significantly in the wake of that, because people and businesses are trying to make sense of what to do in terms of new tariffs, new costs, engaging in cross-border business, essentially. And so that's been tough. Now, the administration on April 9th paused many of the tariffs for 90 days with a signal that they wanted to do that in order to provide some time to negotiate trade deals, and that it keeps being sort of indications that they're making progress. And of course, with all that going on all around the world, China remains in the greatest focus. There's where we've really had a severe, quote unquote, trade war, where tariffs for the U.S. sit at, I think, 145%. China's up there, we'll call it 125 if I have the data right. And so anyway, the bottom line, obviously, is people are watching for any indication that there are negotiations happening with China as well. And, we see mixed messages. From the Trump administration, we're hearing, they're engaging actively, and China, on the other hand, is signaling no interaction. And so obviously something probably is going on, but we won't get any clarity on that. And that sort of creates the challenge, right? With the situation with tariffs, maybe the impact of the reduction in government, it creates quite a lot of uncertainty. And so businesses have to try to pivot. They have to try to figure out how they're going to do what they do, not really knowing where the future lies in terms of things like tariffs. And then, of course, individuals, if people are worried about a recession, maybe people sort of pause on spending. And of course, that triggers a recession potentially. So this has been a sort of an unstable time. Now, as it relates to some data, we had the advanced estimate of first quarter GDP which at the high level, at the total level, was negative. It fell 0.3% in the first quarter, according to that first estimate. And so it's important when we see that, of course, especially if it happens 2 quarters in a row, then that's at least a technical recession. But it's important to unpack it. So when we unpack it, we see consumption, which is the consumer, and by the way, making up 2/3 of GDP, grew at an annualized rate of 1.8% during the quarter. So that's pretty much in line with, I think, what people are expecting out of the economy, a slower level of growth, but still positive. And actually business investment, including inventories, and especially inventories, grew at a positive 22% rate. But the theory on that, just to kind of shine a light on it, is that a lot of that, especially the inventory buildup, could well be spending ahead of tariffs. Now, so those are 2 big positive numbers in a way. And so you ask, well, how can the number be negative? Well, the number's negative because imports, which count against GDP, jumped almost an astonishing 41.3%. And again, the view is that that's imports happening to try to get the imports done in advance of the tariffs being in place. And so, again, that big jump in imports, which on a percentage basis is not a huge part of GDP, but when you have a number like 41.3, it has an effect. And the net of all that is we ended up with a slightly negative total GDP decline for the quarter. Now, people wonder, investors wonder, well, what does this mean for stocks? And so what we know for sure is certain companies, think companies like Delta, Walgreens, General Motors, UPS, basically they've withdrawn what they call their forward guidance. That, hey, sometimes companies will say, here's what we think we're going to do going forward. And basically companies aren't able to do that. And so they sort of, because of the uncertainty of tariffs, and so they basically are saying, hey, we're going to withdraw the guidance and we'll let you know when we know what's going on. Now, I would say in round numbers, when companies report earnings and they talk in their earnings calls and things like that, it's over 50%, but barely over 50%. So if we've had 323 companies report so far, 56% of those have mentioned tariffs in their communications with investors and shareholders. And interestingly, 23%, which is not an insignificant number, but a lower number than I might have expected, mentioned the idea of recession. And that's just capturing whether the words tariff or recession were uttered in the conference. And so punchline here is, a little bit of focus on tariffs for sure, as we would expect, but maybe a signal that people aren't quite as worried about recession. Now, when it comes to stocks overall anyway, we look at what analysts are saying about future, even for the full year 2025. And what's interesting is profits are actually expected to hold up. The estimate for the full year for the S&P 500 is 12.2%, which is a good number. And then that relates significantly to earnings. And while earnings were forecast at the beginning of the year to grow at 12.6% for this full year, that was back in January, given these headwinds, that forecast has declined to 9.5%. So I think important to understand, maybe not quite as good as was expected, but better than average. And so a 9.5% growth rate would be just fine. Now, when it comes to the stock market, through April, so we just got through the end of April, and the S&P 500 as a metric that people like to watch is down just shy of 5%, so 4.9%. And interestingly, it hit a low related to that Liberation Day locally, so hit a local low on April 8th. And since then, the market's recovered about 11.8%. And so those actually are both pretty good numbers, like the being down 5%, which is not an uncommon thing year to year. But then also when we look at the past year, just to pick a number to kind of scoop up a little bit more time. So the year ended April 30th, the S&P 500 was up 12.1%. So the punchline here is it's been volatile for sure. We saw the dramatic moves down. We've seen decent recovery, and there's forces in play right now, absent drama, that would probably signal markets moving modestly higher from here. But of course, the idea of things being absent drama is, just a possibility, but not a likelihood, meaning, hey, we know that the administration and the way they operate and the way they do things, they like to inject drama for negotiation tactics and so on and so forth. And so we'll wait and see how that all unfolds. Anyway, listen, that's what I wanted to cover in this episode. Thank you very much for listening, and we'll catch you on the next one.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.